Guys, quiet please.
Hello, good afternoon. Our academia is that we are going to present Capstone project about shared income. This is content just about everything we're talking about.
So now let's begin with the background, just a brief background so that we can get like a foundation for the rest of the presentation. So Shell is a global energy company that operates in more than 70 countries and also has around 96,000 employees. Its main purpose is to provide energy, reliable energy, while still occasionally switching to lower carbon solutions. Financially speaking, it's a very solid company because it also produces it has a strong capacity to produce cash, also to support reinvestment, and also to provide like sustained returns to the shareholders. Shell also has this flexibility that allows it to not only sustain their oil and gas production, but also to invest regularly in new energy, new transitional energy. Overall, Shell has this balanced approach that is neither going too fast nor too slow. So it really helps protect overall profitability while also still adapting to a changing market. Its business model, Shell operates in a fully integrated business model across the energy value chain. It includes activities such as upstream operations, downstream chemicals, renewable and energy solutions, and also a wide net of trading and supply efforts. This gives Shell overall two strategic advantages. Those are the first, it reduces the exposure to a single segment in the energy market, and what I think by this is that it really allows them not only to have one source of revenue and not only depend on one, so in case one goes wrong, it can kind of balance it out across the different ones. And the second advantage is that it really produces value at every stage for the company, from extraction to also distribution. It really gives and strengthens the position of Shell as it has a long-term stability overall.
Some of the key differentiators Backblaze share step aside from its competitors starts as their strong cash generation. They have a reliable free cash flow and solid business. Shell is known for how they manage their cash flows and cash that comes in. Also, their integrated portfolio, as Sally was something about. They have diversified operations across the food energy chain. They're transitioning not only to the traditional low fuel, but also to renewable energy and other eco-friendly, for example, charging stations. And they also measure energy transition. They are balanced towards low carbon while sustaining cost. They are not leaving aside what they have done throughout the years, but also focusing on that and the energy system. Competitors, we have Capstone and Managerial. Capstone is the largest publicly traded oil and gas companies. They are known, they are also worldwide. They have integrated operations from production to refining and marketing. They produce their product in the production cycle. They take care of production until the customer, as it is present in the marketing. They are known for strong technical expertise and they also diversified portfolio of businesses. For Chevron, they operate across upstream, downstream chemicals with strong focus on production and refining. They are also very present in our its cycle, but one of their strengths is production and they also prioritize operational efficiency and sustainability, and so Chevron is also present in other energy production methods, not only fuel. And they also maintain a global footprint. The key assets in the American stations include almost.
So to start with the analyses, overall, by comparing Shell to Exxon and Chevron, we can see that 2024 was a tough year for all the three companies. We can see revenues and margins going down. And this really meant that it was a challenging environment. And although it was challenging, Shell was able to really perform well in various areas. First, we can highlight that it was able to maintain its balanced financial position and also has a greater liquidity than compared to its competitors. And this really ensures they perform and operate comfortably short term. Also, we can highlight that overall income did decline for three. Shell was able to reduce their debt, and this really helps them because it basically shows they had a solid asset structure, and that also this really strengthened their long-term stability. Also, overall, I would say the results of 2014 shows the Shell is really has a really strong resource management, and that it really can adapt to the market conditions. Also, comparing them to its other competitors, it's really like they can cover with more stability than the other team.
For the profitability ratios, here you see comparison between Shell and Chevron. We have the gross margin, operating margin, and margin story. But we can see that Shell, as you see in the percentages, is very much lower and bigger than Exxon and Chevron. Shell, but have a look here, Shell is still a large company. This does not mean Shell but comparing them side by side, Shell as well as its competitors, as they are stronger and efficient. Although they are lower, the liquidity ratios they are much better. For the working capital, as you see, Shell has more short-term resources than the Exxon, and Chevron much more giving it stronger flexibility. See in years, through the video, Shell has stayed healthy, meaning that's for the quick radio Shell is about 1 in both years, meaning it can cover easier positioning above. And this Shell has stayed constant state at 0.40 shows stronger. This reflects that Shell is a much reliable company. They have short-term resources, more flexibility, and better coverage. That's the context. They are more stable than the other ones, even though that they were weaker.
Now moving on to the weighted average cost of capital. When comparing the three, we can see that, well, first, this tells us like the weighted average cost of capital tells us basically like the minimum return a company must earn so that it can favor and create value for the investors. So based on this, we can see that Shell is the lowest out of all, and this makes it seem as the less riskier one. And also, it really tells us that it's cheaper to finance, and it's also very attractive to investors because they can invest in projects that post long-term returns. Then we can see Exxon has like the lowest value rate, and this is basically like the middle level risk. And finally, Chevron, we can see has the highest of the all three companies, and this basically tells us it's the risk tier one, and that it requires like higher financials, also that basically like they are really susceptible and really sensible to interest rates, the changes in the market, overall changes in the performance of the company. So maybe this slide, in simple terms, I want you to say that Shell is like the safest option out of the three, and that with structure and stability is like really safe for investors. And now moving on to the 2026 forecast, we can say that Shell is predicted to stay in line and consistent with their performance over the past years, and basically that the 2026 outlook looks really good for the company because it really supports the whole stable and reliable image Shell has.
To end up, stock value is valued per share, but it is expected that it is undervalued by 41%, 43. So imagine the possibility of share stocks going up. So it is a big yes buy on share because it shows that it is reliable and its profitability, even though its profitability is below exotic level, it still generates returns and it is generating. So for investors looking into exposure to the sector, we recommend.
Okay.
What kind of profile let me think.
First of all, congratulations. I see a good effort on the presentation. Just some details that I saw. Can you go back to the peers analysis? Try to always be consistent with the typography and the colors of Shell. If you're using the same colors, try to always use like the red and the executive colors, no? Like it's an executive presentation, just a mere recommendation. How did you get to the fair value of the company? On the last, how did you get to the fair value? And why do you think it's undervalued right now?
It is what is presented in the and it is predicted that they are undervalued.
By 51%?
Means that it is undervalued.
Okay. But that's from a source. You didn't check it. You didn't.
Many sources.
Okay, but it has the lowest profitability of them all. Go to the peers analysis. How can you conclude if it's the lowest? Next one, the next one. How did you get to that conclusion if the ROE and the ROA, it's the lowest of them all? Wouldn't you invest in the other ones?
That Shell has long-term potential, really. So it might not seem like it's almost like profitable today, but at the future, like, the future, I think it would definitely like be more better for the investors and want their return, because also like the cash, the free cash flow is really good. So overall, I think it benefits investors on the long term.
Okay. Do you have any questions?
No, I was also, what's the main driver that, in your opinion, will move the needle of the value, the price in the next 12 months? Yeah, in your opinion, you make the analysis. What is gonna be the driver, the main driver that will move the price of the action
The stock.
of the stock? If it's gonna be worth for me to invest today, why? And in your opinion, what's gonna drive my investment to be better in the future, like in the next 12 months?
Because of the new energy sourcing, we are moving beyond traditional fossil fuels and Chile is implementing like more renewable energy, charging stations, and in the future, when there are more, for example, hybrid or electric cars, it is going to be more needed, those type of energy sources more than traditional fuel or oil and gas.
Okay.
I have another question. To make the analysis, what do you think is the main risk for me to invest today in Shell?
We are uncertain on when to start to go up. It has been constant. So we are certain when it's going to invest, but that's the reason.
Thank you. Thank you.
Hello, hi. Today we came here to present to you our annual budget and annual forecast for the Volkswagen Group. I'm Fernando Borrego, Ricardo Rosario, Anastasia Elena Castellanos, and Constanza Cornelius. So today in this presentation, we will go in depth into first, what is the Volkswagen Group, what does it consist, and what does it do, the 2025 actual data like income statement, balance sheets, and maybe the cash flow statement. Wait, you'll see later. Don't worry. We'll go over our forecast assumptions for the years of 2025 and 2026. So that's it.
Okay, first of all, the Volkswagen Group is one of the world's leading automobile manufacturers in the world, and it's also the largest car maker in Europe. It's headquartered in Wolfsburg, Germany, and the group compromises of a multi-brand portfolio, which ranges from volume market vehicles to premium and luxury segments. Some of the most renowned names are Volkswagen, Audi, Skoda, Seat, Cupra, Bentley, Lamborghini, Porsche, Bugatti, among others. This is a full brand portfolio for the Volkswagen Group. As you can see, there's really renowned names, and it's very recognizable.
So with this project, our objective is to develop the 2026 budget proposal for the Volkswagen Group. We're going to incorporate key financial metrics, operational plans, and investment strategies to support sustainable growth and see if our company is actually sustainable.
Okay, so the business core segment, the company is divided into various segments. The main one is passenger cars and SUV, which represents 66% of the share of the company, which equals to 250.4 million. Now the global presence of the company is European, which means that the biggest market is Europe, which represents 46, no, represents, yeah, 46% of the our presence with 42 locations. But they also have presence in all the other continents, showing their how their global companies. Again, Europe represents 4.2 billion. They sell to 4.2 million vehicles last year, which is 194.1 million euros. It's the largest one.
Okay. The selling channels for our company consists of commercial and digital channels. With these, we partner with brands like Capstone, which has direct sales and logistic companies. They also partner with Managerial solutions, and this is a direct business-to-business contract where they both use engines, turbines, and industrial products. They also sell with critical and joint ventures with China, the largest sales market, through joint ventures with the Volkswagen Group and the SAIC Volkswagen. They also sell in North and South America. And finally, their last selling channel is international and mobility services, which are sold together with vehicles. This has a penetration rate of 34.1% as of deliveries in 2024.
Here we can see Volkswagen key clients. We have Northvolt, a Swedish battery supplier. Volkswagen holds a 21% stake to support EV production. Then in China, they cooperated with Xpeng, where they own almost 5% of the of stakes, collaborating on electric vehicles to electric vehicle models and technology platforms for China. Then Volkswagen Financial Services provides financing, leasing, and insurance, and they manage around 18 million contracts worldwide. And last, we have the Capstone Group that includes MAN, Scania, and Navistar that serves logistics, transport, and public sector clients with truck, buses, and engines. We can see here that Europe generates the highest volume with an average ticket of 46,200 euros per vehicle. Then we have the largest revenue per vehicle in North America with 62,700 euros per vehicle, mainly SUVs and the premium models. Then in lower price, we have South America with 31,300 euros per vehicle, and the lowest price is in the Asia Pacific region with 14,200 euros per vehicle.
Now, let's talk about the Volkswagen service. What we are fortunate for. The Volkswagen Group plans to focus on electrifying its vehicle lineup. They also want to increase efficiency through digitalization and AI. Finally, focus on profitable growth. The Volkswagen Group also wants to achieve net zero carbon neutrality by 2050 and prioritize sustainability across its value chain.
Now, before we go a little bit more in depth into the income statement and what each of these numbers mean, we want to clarify how did we get the 2026 and 2025 forecast of these numbers. So for the income statement act, we lack most of the internal documents to make a really accurate prediction. What we just did was calculate the average percentage of increase in the years of 2024 and 2021 for each of these categories, and then just multiply that value for the 2025 and then 2026.
First of all, let's go with the sales revenue from the income statement. As you can see in this graph, there has been a growth. 2021 to the 2026 forecast that we did, company sales sales, it grew by 129.6 billion, which in total represented a growth of 51.8% over the period of 5 years that we saw.
So to be able to grow performance, we first defined some key assumptions. Inflation at 5%, and assuming that Volkswagen is going to sell 8.3 million passenger vehicles per year and 900,000 commercial vehicles at 35,000 and 45,000 euros respectively. There will be total gross sales of 331 billion euros, well, in gross sales. Volkswagen remains a vehicle-dominated business. We can see that the passenger cars represent 68% of the total revenues, being the largest contributor, while commercial vehicles only represent 14%. Then we have the financial services at around 18%, which shows the importance of their financing and leasing services. Then, in Europe, Volkswagen is the largest market. It represents 41% of the total revenue, followed by the Asia Pacific with 16%. And we can see that Germany only contributes 19%, showing a strong domestic market presence. So for the cost assumptions, first, the total cost represents 81% of the total revenue. And we can see that it's mostly from the raw materials and components that represent 52%, including steel, aluminum, batteries, electronics. Then the second largest is the manufacturing overhead at 16%. That includes utilities, maintenance, and indirect labor. The direct labor is 11%. That covers the assembly line, the quality and control. And then we have depreciation and amortization that accounts for around 9%. That reflects Volkswagen capital intensive assets such as machinery, plants, and the ongoing research and development projects. Also, we have a 9% logistics and supply chain for the transportation, warehousing, and the tariffs. And lastly, we have the warranty provisions at 3%, mainly the powertrain, the IT batteries, the over-to-over coverage.
Okay. So I'm gonna go a bit fast because we're running out of time. We went in depth with each expense and how we assume them, same as with cost and sales, we kind of put percentages as Fernando was explaining, and then forecast for the 2026 at the end of the 2025. Some of these are the largest expense is the others, which composes many different sectors of the company, which includes the restructuring costs, foreign exchange losses, impairments and write-downs, litigation settlements, and fee miscellaneous. This was something that I found interesting because many of us assume that our largest expense would be perhaps costs or materials or something like that. That is actually for this. The restructuring rises from 0.18 to 4.1%. The FX losses rose 2% and is climbed almost 2.43%. So what we want to implement here is to analyze long-term FX exposure. With this also perhaps change the project justification and strengthen the compliance and risk management. We provide solutions for most of our expenses, but as I said, we don't have much time. Overall, we calculated that our expenses increased by 5.82% in relation to the sales from 2024 to 2025. However, this means that we have higher expenses in our sales, but our company not only evaluated our current expenses, it is also evaluated by all of what we have been explaining. So that's something we calculate.
Well, talking about the current assets, the company shows an upward trend, which rises from around 200 billion to 284 billion today. Inventories, receivables, and market securities all grow significantly, which increased from 40 to 75%. This indicates higher operating activity, greater credit volume, and stronger liquidity through short-term investment.
Alright. Now we have the short-term liabilities. In this category, the short-term liabilities has increased since 2021, which means that the short-term obligations of the company have increased. The main category of increase is the financial liabilities, and we also have which is mainly because of the company's commitment of transforming completely to electrical vehicles. So that means that they have really increased the investment in the recent years. And Also, like the liabilities have significantly increased, but this is not bad because the liquidity ratio is above 1, which means the company is able to pay its liabilities without getting into a financial crisis. Now we have the capital expenditures. This is the company's investments for the future. Again, this has increased from 2021 to 2026, showing that the company is committed to keep growing the company. The main category of growth is of investment is manufacturer and equipment. This is because the cost of sales represent 82% of the revenue, which means that there's a really high volume of sales, which requires more investment in equipment and growing the company. Also, we have the electric vehicles investment. Again, the company is looking to change to electric vehicles. Means that they have more investment.
For our balance sheet, it's also mostly the same of the process as the income statement and the sales and expense cost assumptions, in which we average their percentage of increase and multiply that by the others, but that's only for half of the sales. For example, we can see in the assets, intangible assets, operating time, equipment, these assets, we also use information from our capital expenditure analysis, and also some information from the cash flow statement that we had already realized. That's not here in the presentation because we thought it would be a little bit extra, and it's also not, well, it wasn't asked, but we did. If you want to see the extra layer, be my guest. And that's what we did for the assets. Then for inventories, we did it by calculating the cost of one inventory day and then multiplying by the total inventory days that we would need to fill the 2025 and 2026 months. And our conclusion is that although we are creating a budget, we're also seeing if we need any outside investment. But as you can see from this change on the sales from our balance sheet, we have a positive cash flow on average. So we at the moment don't really need an outside investment. So we don't think it would be wise to equip our company with more debt as it is. And we have more than enough cash to sustain any investments that we would like to do. So thank you for listening to this presentation.
Guys, please.
First of all, I have 2 tips in the data sheet and in the charts. Avoid using decimals because it looks very proud. And also, if you're talking in millions, then you can use 1,000 and remove the
6 years.
Yeah.
That's also something he said, but since we realized that prior to the date and also our formulas, well, we didn't want to change a lot of things one day to the other. So we will keep that in mind for us.
Just like in the real world,
Yeah.
it's the way. Thank you. If you have to reduce 10% of the budget 2026, which of the things will be like, what would you move from your budget if you had like,
Like if we had to lose like 10%
reduce,
of everything.
Reduce the electrical vehicle investment because it's not, it doesn't need to be as high as it is, but the company is going to change it, makes it so they have invested more, a lot in the electrical vehicle.
Any other questions?
I also have some tips, guys. Go back to your tables. Besides obviously summarizing the figures, you already comply with the colors of and the typography, but not in the charts. In the charts, you're using bluish table. Okay, so try to be consistent. It's an executive presentation. You did well. Obviously, the chart, avoid avoid that chart from the 2023 slide. Avoid just copy pasting the. You can put the background of that chart in black, so it appears as it doesn't have a. Okay. Yes. Look, it looks better, no? It looks better. Okay. It looks more professional, but a very high level and consistent presentation. I congratulate you guys. I don't have any questions regarding. I think you did very well, so thank you very much.
Then our managerial accounting project, that is gonna be the budget for the industry aid. Our team is formed by Alonso and Clark and Felix and me. These are gonna be our contents. These are gonna be the things we're gonna have.
Okay, so for starters, State Street is an American food fashion company located in New York. It was initially founded as Coach, but it was rebranded in 2017 to reflect its broader portfolio. Today, it owns Coach, Kate Spade, and Swerve Ritzman, generating about $6 billion a year and operating with more than 12,000 employees worldwide. The company follows a consumer-centered digital first strategy with strong growth in international markets, especially in Asia, and a fair commitment to sustainability.
This is our forecasting of statement. First of all, we can see here that what we projected is a higher growth in the revenue, and our cost of revenue also grew at the same rate with the total revenue, and our gross profits is higher than the previous year.
Well, in terms of products, in 2025, women's healthcare continue to be the main revenue driven by 48% of the total sales, meaning that it generates 3.3 million with 7 million units sold. Followed by accessories with 21% of sales and men's product with 50%. These categories make up most of the company sales, as you can see, while the rest, like footwear, jewelry, lifestyle, and home, have smaller but consistent contributions. Now, for our sales forecast, we analyze the company's historical performance from 2019 to 2025. Even though there was a decline in 2020, sales recovered quickly and began growing at a steady pace over the following years. These consistent upward movements form the foundation for our forecast. Using a time series model based on this historical trend, we project that sales in 2026 will reach 7,292.44 million, with the same range of percentages in the sales. This continues to be positive, since the company has shown 2021 and reflects a stable, sustainable rate of growth.
So this is our geographic revenue. As you can see, in USA, we have the largest market, 19 up to 59 of those sales. That means that more than half of the company's revenue comes from American consumers, and it's driven most by our main brands, which I mentioned, which are Kate Spade, Coach, and Swerve. And China follows with 15, remaining a key growth region for luxury. Japan contributes 8%, supported by strong brand loyalty. Europe accounts for 7%, and Canada and Australia each have about 5%, providing steady source Europe.
For the grocery channels, the retail stores still represent half of the net sales. showing how strong the brand is in physical locations. E-commerce is also a major channel, and wholesale plus third-party retailers support the overall omni-channel strategy.
So for cost assumptions, we have the raw materials continue to be the largest cost driver, representing over half of the production costs. This includes better textile hardware and other components, which are essential to the industry's life. Direct labor remains fairly stable year over year. Manufacturing overheads such as utilities, maintenance, safety, and factory operations also show consistency levels, supporting ongoing production capacity. And depreciation increases slightly across the years, indicating continuous investments in long-term assets like machinery, buildings, and production technology. Lastly, logistics and supply chain expenses reflect inbound freight and transportation costs, which remain predictable but sensitive to our global shipping conditions.
Now for the expense assumptions. These are the main costs for tapestry. And we have distribution and store operating expenses that includes like payroll and the store operating costs. Then we have selling, marketing, and advertising. That includes all the global campaigns, the publicity to stay relevant and like present in the market. Then we have corporate overhead that are also other expenses that are included here for tapestry, e-commerce and digital operations that continue growing due to investments in online platforms. And product development and R&D that includes design teams, sampling, and
for the current assets, we can see that first of all, we have a smaller amount in current assets than the previous year because we are going to focus more on paying our debts instead of our assets. And for our liabilities, we can see that it's still the same, but we have more focus in.
Well, now for the capex, the gross PPE of 1,704,000 represent the total value of physical assets before depreciation, including land, equipment, construction in progress, and lease assets. The completed depreciation significantly reduces the net value of these assets, showing yearly usage over time. The intangible assets total mainly from goodwill and other intangible rights, meaning the company relies strongly on brand value and has overall, the table highlights a balance where intangibles are almost as important as physical assets. Funding needs. For our 2026 projection, tapestry funding needs show a stable financial position with moderate investments. First, the capex we see small increase, showing more investment in assets. Then we see a decrease in working capital, indicating better short-term financial management. Debt repayments, we see only slightly increase, suggesting management debt. We see dividends, small increase, reflecting steady payouts to shareholders. Share purchases, they decrease, indicating less focus for buybacks. Operating cash flow, small increase, showing profitability. Total funding needs, significant decrease, suggesting less need for funding. And net funding
we made no change showing a consistent deficit that requires deadline.
Okay.
So our conclusion is that the 2026 forecast shows Baker's entering the year with balanced and strong financial outlook. Sales continue to rise steadily and are supported by strong geographic performance and diverse products. Costs remain consistent with raw materials and store operations as the main drivers, while digital and e-commerce investments align with the company's strategy. The projected CapEx reflects continued investment in store improvements, digital infrastructure, and long-term assets. Overall, the forecast positions Baker Street for sustainable growth, operational efficiency, and a stronger global presence.
Thank you.
You go back to the second slide, I guess. The one with the projection of sales. The one with the graph. There. Why are you projecting that kind of growth if since 2022 you have been stable and the market trends are decreasing in the slide before that?
And that was part also of my question. What are the sales assumptions?
Go to the slide before that. So there you have the category trends. Every segment in the market is declining. 50%, 15%, -6%, -6%, -21%.
It's not it's like
An estimate.
I was gonna tell you that.
yeah.
It looks like a minus.
It looks like a match.
But don't worry. Okay, tell us the assumptions.
Yeah,
She has an excellent question.
Go
Like,
to the next slide. You have been the only year that you have growth is between 2020 and 2021, and if you look deeply on it, it's not really a growth. It just make you. So the real growth is between 2021 and 2022, but then you have been 4 years just the same. So why you are projecting for the next year that kind of growth?
and I don't think that chart is correct. Because the chart is telling you that it's 10 million, and in your table, you're putting that 2026 it's gonna end up in 7,292,000, which is more reasonable than the 10 million.
Just 3%, I guess, in the chart, but a lot more in the graph. Why?
Are you understanding what I was saying?
So why you are telling us your sales are gonna grow this year versus next year?
I think there was a small error in this table, because we have here, it would be, like, not as much.
Okay, don't worry, but why it's gonna grow to 7 million?
We believe it's gonna grow because first of all, Inventory Group has bought or has a merger with another company that's Capstone Holdings, and what with this merger, what they're trying to do is get better sales and boost their sales because maybe the merger company.
By how much? Where can I see the sales assumptions for that?
In the slide before, there's the sales assumptions.
That if you like remains the same percentage as the
Show me.
forecast, the less, not less.
I think that's the product mix. The product mix of your total sales, how much it represents woman's handbag from total sales, no? How are you gonna grow from 7 million from 2025 to 200 million to 2026? What are you gonna do? Increasing prices?
Our first step is increasing prices and also increasing our advertisement or just improve our sales and try to acquire, like I said, the company to be able to better.
Okay, go to your funding needs, please. How do you calculate the funding needs? The last one, funding needs.
Our funding needs were calculated by how we thought the trends were going, how it was a small increase, but it's not very, we hope to be stable. We don't want to like grow exponentially, so we don't as stable we would be. Not increasing so much and focusing on our.
What does it mean, shares repurchase?
To repurchase their own stocks.
From who? Are you gonna repurchase your own stocks? Okay. And what is working capital needs?
Like stores, machinery, or whatever for those invested, like remodeling stores and renovations.
That should be capex. But what is working capital needs? So we finished the time, guys. Thank you very much for your participation.
Our next presentation is our Capstone financial analysis project, and in this one we will see if we should invest in fitness paper.
Well, so as last presentation, today was creating, it's an international luxury goods company based in New York City, blah, blah, currently on the coast, blah, blah, but it was renamed in 2017. Next slide, please. We know their major, well, so their major competitors are Capri Holdings, which is armed with Michael Kors, Versace, and Jimmy Choo. And it competes in accessible luxury, but its brand partnership is facing profitability challenges. Then we have LVMH, which is the world's largest luxury group. It's composed by brands like Louis Vuitton, Dior, Fendi, and the strongest financial performance and global presence. Then we have Kering, which is a luxury fashion group, which is made by brands with Gucci and Saint Laurent and Balenciaga, and it competes in high-end leather goods and fashion. So we first start with our profitability ratios highlights. So we have the gross margin. In 2023, Kering's gross margin was the highest one with a percentage of 76.29%. However, in 2025, Tapestry becomes the highest between all of the companies with a 75.42%. Additionally, Tapestry's gross margin increased 2.5 percentage points from 2024 to 2025. Then we have the operating margin, which LVMH will be the highest one and strongest percentage with above 20% between all the companies. And following, we have Tapestry with a 6% difference in 2024 between LVMH. And also in 2025, we can see that Tapestry becomes the leader between Capri Holdings. Okay, and the next one will be the net margin. Well, in this case, LVMH gives the highest rate from all of them, with a percentage gap of around 11.36%. And in 2024, Tapestry becomes the second best with 12.23%, and leading 2025 with a gap of 29.15 percentile points above Capri Holdings. So we can say that this LVMH converts sales into final profit more efficiently than its competitors.
We have the optionality equity or ROE. As you can see, LVMH has the highest ROE among the others, and it's significantly. In 2024, LVMH posted a ROE of 33.19%. This is nearly 5% percentage point higher than the next competitor, that is Fairness, with a percentage of 80.0%. And substantially higher than Tapestry, and that is 21.36%. So this command in ROE indicates that LVMH is demonstrably the most efficient company in this period set at using shareholder capital to generate high profits. Next, we have the ROA or return on assets. And here again, the data shows that LVMH is a clear leader again. It's with a ROA of 10.49%. This is over 3 times the ROA of Kering at 2.83%, and almost 4 times that the ROA of Tapestry at 2.78%.
So in profitability ratios, we can conclude that while LVMH is the best in the market between these companies, Tapestry is the second, or it's trying to do its best to become the first. Now let's current ratios. There's liquidity ratios. First of all, Tapestry drops from 3.27 from 2025, but it remains above Capri. LVMH has a percentage of 1.41 in 2024 and Kering of 1.22. So it means that in this group, it still has the highest current ratio. In our quick ratios, we can see that is even if Tapestry decreases from 3.25 from 2024 to 2025, the 1.31 is still higher than the Capri Holdings, and LVMH is 0.71 and Kering 0.80. So it means that it has the strongest quick ratio among these companies, and in the asset test, Tapestry falls from 2.59 in 2024 to 0.71 in 2025, but the 0.79 is still above all the other companies, meaning that in liquidity ratios, Tapestry has the best results in that.
Okay, for 2025, we know that Tapestry increased from 1.52 to 4.55. So it's lower than Capri's, but higher than LVMH. And this means that Tapestry used less debt to cover compare with equity, but more debt than LVMH in Carry. Tapestry also has 13 in 2025 above Capri's 0.07, but below LVMH 0.45 and Kering's 0.36. This shows that equity finances a smaller part of Tapestry's assets than LVMH and Kering, but a larger part than at Capri's. And for interest coverage, Tapestry is 14.87 in 2025, higher than Kering and Capri's, but a little bit lower than LVMH. Meaning Tapestry earns about 14.87 times its interest expense, so it can pay interest more easily than Capri and Kering, though not as comfortably as LVMH.
In the financial cycle, we can see that in accounts receivable rotation, in 2025, Tapestry turns its receivables 13.57 times per year, slightly less than at Capri's, and LVMH's slightly less than Capri's, and LVMH's at 14.44, and LVMH's is at 14.44. And in the inventory rotation in 2025, Tapestry turns its inventories 2 times per year, a bit more often than Capri at 1.87 times and Kering at 1.6, but much more often than LVMH that just does it for 0.08 times. And in accounts payable rotation in 2025, Tapestry pays its suppliers 2.42 times more per year, more frequently than at Capri, but less frequently than at LVMH, and far less than Kering. And in accounts receivable days, Tapestry takes 26.90 days on average to collect from customers, very close to Capri, slightly lower than LVMH, and above Kering. So it just shows that Tapestry is not the best, but it's trying.
For inventory days, we have they have 182 days, and they're known as the fastest. They're more efficient than Capri that have 196 days, and they outperform Kering with 342 days. For accounts payable days, Tapestry and Capri have the best leverage, delaying payments to suppliers for over 100 days to keep cash in hand. Kering has the weakest leverage, paying just in 16 days. For the financial cycle, Tapestry has the most efficient cycle with 103 days. They recover the cash investment faster than both Capri with 113 days and Kering with 326 days. For the WACC, we have that Tapestry's overall cost to fund its business is 7.26%. This means any new project or investment must earn a return higher than 7.26% to create value. The company is funded primarily by equity, 64%, which is the most expensive source of money at 10.72%. And the debt advantage is that despite the high cost of equity, the WACC is kept relatively low because the cost of debt is extremely cheap. It's 1.4% after tax. And what we can conclude is that Tapestry leads with the highest gross margin and the fastest cash recovery cycle, what I mentioned about the 103 days, beating all peers. They have a strong liquidity, they have the biggest safety net, holding the highest current and quick ratios in the group. And for cheap capital, funding is very inexpensive, largely due to extremely low cost debt. And our recommendations would be leverage cheap debt to use low borrowing costs to fund aggressive growth and new acquisitions. We have to reduce excess liquidity by investing it or buying back shares to improve return on equity. And this will trail to LVMH. And to maintain the speed, keeping the inventory days low in 180 days to preserve the competitive advantage over the carrier. We have also yeah. Okay, the price of the stock, and we can conclude with that part.
What is your conclusion?
Our recommendations, like what they can do, and
I have a question. Yeah. Should I buy a tapestry stock or not?
Gonna be honest, I believe in the market it's gonna be better LVMHs because while tapestry is not the worst, and it's not close to being, but it's still behind it. So I would recommend to buy LVMHs because it's between these companies.
And what should be changing in the market in order that tapestry plays the best option to invest in?
The thing is, it is competitive, as we said, with how they manage their financial cycle, but okay, we will enter more in detail with LVMH later, but what they have like an advantage is how they have like how do you say, they have a better they're selling the three of them. We wanted to compare them. We can know that LVMH is better, but I don't know what to explain.
What can make tapestry better than the other ones? The days of payment, the debt, you can recommend me to invest on it.
What could tapestry do better? So if they do this, it would be
To reverse
recommendable for you to invest.
Yeah.
So I think first they should focus more on the low brands. Looking more at the sales and what's going, like what of all the brands is the best one, and try to focus more on it, but at the same time keep working on the others and try to see why the others are not having the same value or importance to customers as a person.
Okay, go to your profitability analysis, specifically to the ROE analysis. ROE, okay. LVMH has a high return. Okay. The conclusions, try to keep them on your, it's like a thesis analysis. The thesis is, would you recommend tapestry or not? So your conclusions can't be like invest in LMPH. Currently, it's not the most okay, and maybe they can improve as your recommendations by doing this. Okay, next, go to another one. Go to the financial cycle. Okay. No, before you didn't even include LMVH to your conclusions because the LVMH financial cycle is incorrect. Okay. How do you know that it's not correct? Look at the inventory days. They have 4,558 days of inventory days.
Yes, correct.
It has a financial cycle of 4,492 days.
We will see that in the next presentation.
You have to be very careful with those things because at the end it's an executive presentation. It has to be reviewed before presenting it. Thank you. Thank you very much.
Looking at LVMH, which is its own awareness, and then Louis Vuitton is from France, based in it's the world's largest luxury goods company owned by self-defined people brand, several of which among our most recognized names worldwide, which include Christian Dior, Louis, and Dempeyron, from fashion, leather goods to wine and spirits. LVMH has mastered the art of desirability, the single most crucial element for success in the luxury market, according to the founder and CEO, Bernard. We have a lot of luxury brands like Givenchy, Dior, and Peyron, and Hennessy. Also, it has achieved its solid performance, which has generated a lot of revenue at 84.7 billion euros as of 2024, and with the net revenue of 19.6 billion as profit. And in 2024 alone, we have they have installed about 6,300 7 stores worldwide across about 75 brands with 250,000 employees. Revenue by business group. We have the perfume and cosmetics at 10%, with about 8.48 billion euros, wine and spirit at 5.86 billion euros. Watches and jewelry are 10.57 billion euros. Fashion and leather goods at 41.06 euros. With the selective retailing and other activities at 18.26 billion euros.
Now we have here a balanced geographic revenue mix where we can appreciate that it has a bigger percentage in Asia, including Japan. Then it's followed by Europe, United States, other markets are 13%, and Japan with a 9%. Okay, here we can see, as I mentioned before, the biggest growth driver is Asia, with mainly growth in China and Korea. For Europe, we have a stable local consumption, including tourism recovery, and we can see the comparison from 2024 to 2026 in terms of revenue. And for other markets, we have biggest growth in Latin America and the Middle East. Now, by revenue, by distribution channel, we have retail, that is the main channel with their flagship stores boutiques and stronger like in-store experience, representing change growth of 22% regarding from 2024 to 2026. Then we have e-commerce that are like they have been growing rapidly, improving their websites and the more integration with physical stores. Then for wholesale, for B2B distributors, we have a gradual reduction. Wholesale farmers they will direct consumer channels. Now we made some key assumptions for this 2026 forecast, taking into consideration some macro and strategic assumptions. For inflation, we have that in luxury it's around 3.5%, which pushes both input costs and selling prices high up. We have an exchange rate from euro and USD dollars of 1.08. Has a slight euro appreciation, and then we have other factors like marketing and promotion expense, 36%, operating efficiency gains, 2%. That means that it has a digital transformation that offsets inflation. Then we have a comparison of our forecast from all the years to total sales from 2021 until 2024. Then at the end where we have 2025 right now, and then our forecast of sales for 2026 that it's 102.4 billion. Okay, now we have here the income statement showing, we can see here our total revenue that it grows from 84 billion to 102 billion approximately, with a 21% increase. That it shows that the luxury market remains resilient and demand continues to rise in the inflation. That has one of the key assumptions that we made before. For cost of revenue, we can see the increase from 27.9 to 32.6 billion. And even though costs grow, the company keeps its cost structure like stable. This means they manage efficiently production, materials, and logistics. For gross profit, we can see from 2024 it was 66.7, growing to 69.84, meaning that this is a margin around 16% approx. That shows that LVMH has extraordinary pricing power and brand strength, and that customers are willing to pay greater prices. For operating expenses, OPEX, including selling general administrative, selling and marketing, and other operating expenses, it increased from 37.1 to 43.5, meaning that they invest a lot in this things that I mentioned before, but remain consistent with their sales, showing a balanced management between investments and income. For the operating income, we see an increase from 19.5 to 26.3. Meaning that growth here means the core business is becoming stronger thanks to strong sales and stable markets. For the pre-tax income, we can see that it raised to 25.5, meaning that the company creates a big value even before taxes. This is driven by strong operations and their controlled expenses. And for the tax provision, it means that their tax expenses rise because their profit rise, but the tax rate stays consistent, which is positive for its predictability. And finally, for the net income, we can see here it increased to 18.2, meaning that they know how to convert a large portion of the value into real profit. Now we have the assumptions for
For
2026.
2026. Yes, first of all, we have wines and spirits. We can see the prices stay flat with a 22% growth, and it comes entirely from selling more bottles. For fashion and leather, it's the one that has more profit, and they raise the prices by 300 euros to boost their margins. For perfumes and cosmetics, they have a growth by selling huge quantities to a wider audience. With watches and jewelry, they increase price by 400 euros to target wealthier clients and increase the exclusivity. For selective retailing, the prices stay flat, and the growth relies only on getting more customers into their stores. And for other activities, the revenue doubles because they're doubling the average price to 3,500 euros. Our cost assumptions, we have first of all raw materials, and we have that the prices went up of leather and glass, but we wasted less in the factory, so overall cost percentage dropped. For procurement and logistics, we have that the shipping rates increased, but we optimized the delivery routes to lower our total spending. For retail operations, the prices rose due to inflation, but we use energy saving technology to reduce electricity bills. For manufacturing labor, we increased the wages by 3% to keep our artisans, but with new machines, we help them work faster, lowering the cost per item. For quality control and testing, we launched more products, but using automated inspections to keep the cost down. For packaging and labeling, we use eco-friendly boxes that cost 2% more, but buying them in massive global bulk to keep the price steady. For e-commerce fulfillment, that's the only increase of them from 1.2% to 1.5%. And the online orders surged by 25%. Shipping individual boxes to homes is more expensive than shipping them to stores. The total cost of revenue was changed from 32.9% to 31.9%, so our efficiency improved. We now spend 1% less on making products, meaning more profit for the company. Now, our expense assumptions is, first of all, advertising and promotion. We're spending more on big campaigns to buy ads smarter, and the cost per view is actually going down. For sales and distribution, we have 24.5 billion to standardize how stores work run globally. This keeps our staff and the commission costs stable, even as we open new locations. We have general and administrative. The salaries went up, but we saved money by centralizing teams like human resources and finance into one hub. We have 1.5 billion with IT and digital systems by spending on cybersecurity and customer data tools to keep our growing online faster.
Okay, now for the balance sheet, we have current assets, and we can see here for the most important part here is for cash equivalent to short-term investments. We can see that the cash grew about 3.7 million because we actually reactively invest in paying down debt and using our own cash to grow instead of borrowing. For inventory, you can see that it increased by 4 million to ensure we have enough supply to meet the 2026 sales forecast. Next. For short-term liabilities, we can see that for current provisions, it slightly increased the same net money set aside for potential risks like credit returns, consider that it has like a slight increase. And for current debt, we paid off about 1.1 million in backwards. We use our own money profits to reduce debt instead of making working profit. You can see that what we just said, more like visually represented in this graph. Now for the working capital table, we have here that what I just said, that inventory days, we have 309 days that represents around 84.8% of our current assets, meaning that our inventory is high and like we have that because the items are handcrafted and not mass produced. For the current provision days, we have like 17 days that represent a 4.7% current liabilities, meaning that they have very low short-term risk. For a long term, we have 21 days that represents a 5.88% of our current liabilities, meaning that the future risk will be controlled. This is extra, we can pass on that. For what calculation, that we can see that it's at 6.52%, meaning that they are financed mostly by an equity of 85.65%, and in debt it's only 13.35%, so they are financially strong and creating CapEx.
For the CapEx, we have additional investments for 2026. So we have like the difference from previous year. We have for buildings, renovating top stores, for machinery, that's the biggest increase with 196. Buying AI tools. For lands, we're acquiring new land for wines and spirits. For properties, we're buying strategic buildings in key cities, 2 on the location instead of renting. For construction, we're funding ongoing projects to ensure there's enough product stock. And for software, we're purchasing the licenses and digital tools needed to run the new high-tech system. And in total, it's 372 million to fund the initiatives. As for funding needs, we can say based on our projections that we do not require external funding, even though the total assets increased by 14.3 billion. The cash decreases from 13 to 9 billion because LVMH chooses to self-fund rather to go on debt. And we remain highly liquid and financially strong, so we don't need to raise debt or equity for 2026.
Okay, so right now I'm going to so here what we can see the evolution of NPMI share price over the last 6 months. On the number of EH 25, the stock exchange is 627 euros with a daily increase of 0.32%. So the charts show that the price stay able to be stable during the summer, and there's a rising sharply from September onward, reaching one of its highest level in November. On November 26th, so the stock closed at 625 euros with a height of 628.10 euros and a trading volume of about 287,000 shares, which shows strong market activity as a trend and great investor confidence in LVMH. So the report analysis shows that LVMH remains extremely strong and growing leader in the luxury sector. Based on corporations, the group should reach 102.5 billion in revenue by 2026, which represents about 21% growth compared to 2024. So the main driver of this increase are Asia, with more than 5
the United States, and the United States will fall beyond. We estimate the distribution channels making 84% of the sales 2026, while e-commerce is fastest growing channel by 45%. 20%.
Okay, we have to finish, guys. Let's move on to the questions. Like, what was the purpose of this capstone project? It was to get an approval for your budget. Okay, so the conclusion, it's not even related to the topic. No? Do you have questions?
No, I was confused between which of the two topics you were included. So just the same question. I found it like very, I mean, the slides were very clear. It's easy to follow, but at the end, I got a little bit lost between which of the projects you were, of the objectives you were reaching. In terms of the investment, I got what the conclusion was, but in terms of the budget, I'm not sure.
Okay, so go to your funding needs. What was the conclusion on the funding needs? How much money do you need? Why not?
Based on say was because our cash, the reference that the forecast that we made, we can see how for 2026 the needs of cash increase. So because they choose to sell one rather than take some money because we can like cover.
I get that you don't need fundings, and you have like just a highlight, a very clear strategy that you mentioned before. It was the way they will increase their incomes during the year. But you just mentioned them like selling more units of bottles, increasing more than 300 euros. The jewelry, I don't remember the other ones, but there were clear strategies that you have like to make this kind of conclusion. But then you just leave them in that slide. It's very it's very important information about the strategies the company will use next year to achieve all the financial objectives, and you just leave them there. So for me, I think there's a tool or the key to make these conclusions here, and your conclusion is your budget. What do you need? Your forecast. Not only if you will need more money or an additional investment, but your budget and the strategies that you will follow to achieve that forecast.
So Matthew, you only participated in the conclusion. What was your contribution regarding everything? Because at the conclusion, it's not even related to the topic. What was the contribution besides the conclusion? What? What was your contribution to everything else rather than the conclusion that is not even related to the topic? What did you do? Sales assumptions, cost assumptions, expenses, the funding calculated, the funding needs. Can you raise your voice because I But what did you do? What was your contribution? The cost assumptions? And why you didn't present them? Okay, thank you guys. Let's go with the next one.
For that question, I think we tried to include everything we needed to say, but we had to get to the point that we wanted. I understand like what you're saying, but with the time on the rush, we couldn't like get to the.
Yeah, but it's
the
a very
point.
good information. That
Yeah,
you
I
have,
understand.
and it's like the backup of these conclusions.
Yeah. Yeah. Thank you.
Okay, good morning, my name is Lorenza, and today we're gonna present the Capstone project based on the company Apple and its 2026 projection project. For this project, we have two main objectives. Firstly, analyze Apple's historical performance, financial performance, to identify revenue trends, cost operation, and cost behavior and operation efficiency that might influence future projections. By this, we aim to present the 2026 budget proposal for Apple, covering key financial metrics, operational plans, and investment strategies to drive growth. Starting off with the company's background, we know that Apple is an American multinational technology company focused on manufacturing, designing, and marketing consumer electronics, computer software, and online services. Apple has become one of the largest companies worldwide by market value because of its innovation, the system integration, and the brand strength. The market capitalization as of November 2025 is of $4.12 trillion. Talking about the global presence, Apple has around 535 store locations distributed in an estimated of 27 countries. And in this map, we can see the key regions in which the Apple is present and some countries in which its operation has been suspended. From this point, we will analyze the financial data that will serve as the basis to develop our 2026 budget proposal.
Well, we have the total revenue, this is so perfect. It's 448,268. And how we do it, how we get that amount? First, we gather the historical data, starting with the total revenue in 2015 until 2025. Then we apply the linear trend line that gives us the equation, and the R2, that is the reliability on the data, which in this case was 92%. And then finally, using the data analysis tools, we project the total revenue for 2026. Well, we have here the main products that are the iPhone, the software chips, the home and accessories, Mac, and the iPad. And also the main countries, the US, China, Singapore, UK, and other regions. The increase was in general 14.64%. Sorry, I'm not interested in the video. Well, sales assumption. Well, we increased the demand for the iPhones, especially among younger generations, and the 5G in technology expands, and the growth in services like Apple Music, iCloud, and Apple TV, and also the strong sales, the wearables accessories, particularly in as health and fitness trends continues to rise. Well, we developed the.
Now here we have the cost assumptions. So we have different areas, which is raw materials and components. We have direct labor costs. We have manufacturing overhead, depreciation and amortization, and R&D, which is research and development, sales and marketing.
And it had a general increase of 17.5% from 2024 to our broadcast in 2026. With the goal. Okay, now we have the cost assumptions. We have the total costs projected to grow by $36.84 million. So in this, we have the key drivers for the growth that include the increased demand for Apple products in sectors like technology or other services. We also have rising and temporary operational costs. We have strong demand from China's growing middle class, and we have higher logistics and production costs. Then we have the expense assumptions, which is we have different areas like cost of sales, research and development, selling, general and administrative expenses. We have depreciation and amortization, and we have other operating expenses, which had a general increase of 5.35% from 2024 to 2026. So the total expense is projected to grow by $3.075 million. Some of the key drivers include the new market penetration. They're expanding their investments in areas like India or Southeast Asia. We also have adapting to local demands in different types of countries. We also have investment in new technologies as well as sustainability efforts.
With both the forecast and the assumptions, we were able to complete our income statement, the part of the budget for 2026, and the part for the forecast of 2026, which was pretty simple. Now, in order to complete the balance sheet, we will start with the figures.
Well, let's dive into our capital expenditure strategy for 2026, which is critical to sustaining our growth and innovation in the next few years. Capital represents the money we're investing in physical assets such as machinery, facilities, data centers, and equipment. These investments are essential for maintaining our leadership position in the tech industry and preparing. Okay, we have a detailed breakdown here where I'm going to explain what is most important for us to grow the company. In 2026, Apple is investing $13.11 billion in capital expenditures, reflecting a 3% growth from 2024. The next PPE investment will account for 37% of our total CapEx, with a 6% growth from 2024. This will be the main driven by expanding US silicon engineering hubs and us investing in the robotics for iPhone assembly, Shenzhen, and shifting productions to Bangalore, India, to lower labor costs and reduce reliance on China. Our gross PPE investment will make up 30% of our total CapEx, with an increase of 3.11%. Key projects include extended data center equipment in Ireland, strategic GPU clusters for AI, ML, and workloads in Nevada, and diversifying our manufacturing operation in Denver. Additionally, land and improvements will represent 20% of our total CapEx, and growing by 5.18%. This includes land purchases in Dublin, Ireland for data centers and new R&D campus in Tokyo for micro OLED displays and AR technologies, and a distribution hub in Sao Paulo to reduce logistic costs in Latam. Our machinery, furniture, and equipment investment, which will account for 70% of total CapEx, will grow by 3%. This includes robotics in India, expanding macro productions in the US, and battery assembly in Korea. Finally, our leases investment will make up 5% of the total CapEx, growing 5.22%. This investment will support the expansion of cloud hubs in Singapore, retail presence in Sydney, and new development center in Istanbul. This investment will ensure that Apple remains at the forefront of cloud infrastructure, global manufacturing, and innovation of AR, VR, AI, and next-gen technology, position us to meet increasing global demand and achieve competitive
to develop our budget for 2026 within our balance sheet using different formulas and leaving us open to complete the segment of cash and short-term investments. In this case, what we did was to equal our total assets to our total liabilities, and therefore we got the value for the 2026 cash as equivalent and short-term investments. Subtracting that quantity for 2026 compared to the 2024, we were able to find our funding needs, which was a total of 759,429 millions. To allocate effectively these funding needs, we suggested this breakdown. Firstly, we would give 20% of the total funding to research and development, given Apple's emphasis on innovation and technological development. 33% for capital expenditures because of Apple's continuous expansion and need for operation efficiency. 20% for marketing and branding to ensure that Apple maintains its brand position. 14% for acquisitions and strategic partnerships to broaden its product portfolio and enhance the ecosystem with new technologies. 6% for supply chain optimization because it's a priority to mitigate the risk and ensure a smooth flow. And lastly, 7% for environmental sustainability initiatives because for the last few years, sustainability has been a core commitment of Apple. The way we would finance these funding needs would be with our debt. How did we get to this conclusion? We use the WACC.
So here we have the WACC. What we can see the most important part is the cost of debt. They have very little cost of debt compared to the cost of equity. So that means what they're doing is they're financing most of their operations with debt. So in this case, what they're doing is they have such a low percentage because the tax, the income expense that they're using is tax deductible. So that means they can represent it in another way, which should bring this percentage down. And now we have the higher cost of equity, which is 9.28%. Equity investors expect a higher return because they're taking more risk compared to debt holders, and this leads to a higher overall capital cost. And at last, we have the debt over equity. Cost efficiency, debt is financing is a better option as it comes with a lower cost of capital. We have the leverage, which borrowing enables the company to maintain control, no condition of ownership or shares, while still accessing funds at a lower cost. And then we have the tax advantage, which means interest payments on debt are tax deductible, further reducing the overall cost of financing.
So to conclude, we can say that Apple revenue is expected to increase in 2026, highlighting its continued success and resilience in the competitive market. We also can say that the funding needs that are around a total of 760 million, which support the innovation infrastructure growth and the brand positioning. And lastly, given our analysis, we can say that given the lower cost of debt compared to the equity, it is better to finance the funding with the debt because it's more cost effective. Thank you for your attention, and these are the sources we used for this project.
Just one of your conclusions, it was that they are using more debt and it's not correct. Go to the WACC. They are financing with capital. Even if it's expensive, they are financing with 57% capital. Market cap, go to the market cap. With 57%, they are financing with capital. Even though it is cheaper to finance with debt. So the conclusion that you're gonna use debt to finance your funding needs, it seems correct for the board.
If I remove 20% of the investment that you're asking for the next year, What will be your new allocation?
What do you mean if you move?
If I remove 20% of what you're asking for,
Oh, okay, we will probably deduct in general from the segments that we shared. But, I think that we will still focus on research and development, because it's the most important, in my opinion, and given the strategic, investments from companies that are of Apple scale. And also on the capital expenses, that those would stay the same, maybe the others would deduct.
Very good. Thank you.
Thank you. So, hello everyone. We're going to present our Capstone project by BMW 6.4 forecast. My name is Emilia and Brianna. So for my section, I'm going to explain the main objectives of our project. So what we did from BMW is we wanted to talk in the forecast by presenting all the key financial areas for 2026. And this includes sales, cost, expenses, assets, liabilities, capex, funding needs, and IRR. We basically base everything on historical data from 2021 to 2024, plus the P plus the TTM results and different scenarios built from 2026. BMW has a large connection network with sites.
Can you raise your voice, please?
The biggest fans are Germany, US, Mexico, China, UK, South Africa, India. These factories make new cars, but also heating, Rolls-Royce, engines, and motorcycles. BMW is also moving toward electric mobility with new plants. I don't know why everywhere, that's what it is on the electric cars.
Sales and markets, BMW is strong local customers, selling in more than 100 countries. China, most important market, is around 30% of total sales, followed by the US and Germany. BMW also created its own sales systems there to keep their control over the brand and customer experience program. Okay, so the sales assumptions. In 2022, BMW sales are driven more by the production limits than the demand. So the demand for EDS models and like for an iX is like very strong, and BMW keeps solving like pricing the power. So, but the semiconductors shortage, we restrict how many cars can be delivered and currency fluctuations after the revenue translation. So these sales will increase, but not as much as they would due to the production cost line. So aluminum and high strength steel between 2021 and 2022 is cost increase mainly because European energy prices went up and the global EV manufacturers were demanding more lightweight materials. Also, since BMW buys a lot of important materials, the depreciation of euro made everything more expensive. And all of this directly BMW's costs. You can see how the cost of the revenue jumped from 89 million to 182 million in just 1 year.
Electronics are more expensive because their chip shortage continues. BMW uses more sensors for safety and driver assistance, and that increases cost. Shipping is more stable now, but prices are still higher than before. Strong global EV demand adds to the pressure on chip supply. This makes electronics one of the reasons why total cost rises equal to
different powertrains and batteries. Electric and EV powertrain comes with main because due to low prices, which very hard to these higher battery costs surely goes to money. So other components are oil. These are like the smaller parts that are going to like kind of like added up. So higher oil prices, like plastics and rubber are more like expensive raw materials. So global inflation pushes like the suppliers to shipping steel like the prices that it was before. So that way the labor costs are up. And individually they are small, but together they are like a millions to the coaches. So in that way they contribute the transportations for allocations to the need. How all bus drivers practice public bus. So in 2021 and 2022, the biggest jump came from the metals, water, extensions, and rollworks. Those were the three categories which by Hudson, the partly on board. In 2023, what's peaked again because the electronics, EV, and the power trains were still expensive. By 2024, they stabilized the improvements in shipping materials cost still stays high. And for 2026, both the forecast and budget stay above 126 billion because EV investments and battery components keep costs increasing. And global use expansion of servers and social networks, as sales increase, service and distribution costs also rise. R&D spending goes up because we don't systems, new battery tech and digital features. These higher SG&A and R&D expenses push operating margin below, especially when it comes over the time. BMW upgrade expensive computers due to inflation and higher expenses, marketing and customer support. At the same time, R&D spending grows because of investment, battery technology, driving system. We reduce operating margins in the short term. So the current assets and assumptions are the current values that are rising because the materials are getting more expensive. So the cash flow trades depending on EV investments and higher capex needs. Working on the capital requirements that are the short-term liabilities and assumptions. Here we explain how BMW's short-term liabilities behave, how accounts payable rise because the BMW is buying more expensive components, especially as costs from 118 million to especially 125. The short-term debt is used mainly to support the equity during periods of high capex and the inventory buildup and the fraud leverage increase because of the higher manpower costs and the more R&D activity. So overall, short-term liabilities increase to support BMW's operating investments. This table shows BMW's capital spending from 2021 to the 2026 forecast. We see steady investment in property and equipment, their focus on depreciation also rises as BMW has more assets. For 2026, capital stays at about 8.3 billion, which shows
in 2022, BMW faces like the higher operation costs in big investments needs. So external funding is maybe necessary. The cost of revenue jumps about 29 million. Inflation hits the material and logistics and inventory rise due to the supply delays. So to cover this, BMW can use short-term debt, long-term bonds, and for a infrastructure or green financing. If this continues to operate, cash flow isn't enough to the 8.3 million that they have CapEx. So the additional funding is required.
For the IRR, the calculation is based on the expected future cash flows from the BMW's CapEx investments. This includes varying model upgrades, in platform development, and in digital manufacturing projects. Since CapEx is around 800 million, the IRR helps us determine whether those investments generate returns above the BMW's cost of capital. So basically, the IRR tells us if these EV-related investments truly create a long-term value.
In 2022, sales rise because of higher demand and strong pricing, plus increased shortage of chips, batteries, and logistics. Costs jumps from around 89 million to 103 million, and then to 100. Margins is higher in 2022. Because cost pressures are not pricing, CapEx stays high to support shift to rates. Needs depend on if cash flow can cover the investments and ERR shows its vehicle
That's it? Okay. Can you show me the income statement? What's the budget for the income statement?
Can I show you the
No. No. It has to be in the presentation. You didn't put it in the presentation? Or the balance sheet? Go to your sales assumptions, please. Can you go to your sales assumptions? That's an expense assumption. I need the sales assumption. Okay, that's the sales assumption. So with those sales assumptions, how much sales increase you will have for the next year? Mhm. Yes, you can. And why are we comparing 2022?
It's the base from 2022.
Okay.
It's like time.
Okay. How much it increases in sales?
Increases of 2.5.
2.5%? Okay. What's the total amount of sales?
.3%.
Okay. Can you please explain, all of you, anybody who wants to explain it, how do you get to the funding needs? How do you calculate them? Do you have any question? Okay, thank you. Thank you very much.
Gradually, we're going to present about our 2026 budget. For the background, Walmart was founded in 1962 by Sam Walton and Rogers, Arkansas, and today the company is headquartered in Meadowville. Over the years, it has grown into one of the largest retailers in the world, operating across multiple countries and employing hundreds of thousands of people. Walmart describes its mission as being a people-led, tech-powered, omnichannel retailer focused on helping customers save money and live better.
Okay, so starting with our brand promise and objective and omnichannel strategy. Our promise is the foundation of everything we do. To help people save money and live better. To deliver this, our objective is to offer value, convenience, and choice. The key enabler is our omnichannel strategy. This is how we connect physical stores with our online apps, so customers can shop absolutely anytime and anywhere. Okay, so next we look at the we look the key strategies and key pillars. These are our four essential focus areas that drive our strategy. We heavily focus on technology to modernize the shopping experience, maximizing the supply chain efficiency to keep costs low, expanding our high margin private label brands, and aggressively growing our e-commerce footprint.
Walmart begins in 1962 when Sam Walton opens the first store in Rogers, Arkansas. In 1969, Walmart becomes an official corporation, making the start of its expansion. In 1970, Walmart opens its first distribution center and goes public, which accelerates its growth. In 1983, Walmart launches Sam's Club, expanding into the membership warehouse model. In 1988, Walmart opens its first supercenter, combining groceries, general merchandise, under one roof. In 1991, Walmart takes its first step outside the U.S., beginning its global expansion in Mexico City. Between 1994 and 1999, Walmart grows rapidly around the world, entering multiple new markets. In 2002, Walmart becomes the world's largest retailer for the first time. And from
2016 to 2020, Walmart invests heavily in e-commerce to compete with online retailers. And in 2020, the pandemic boosted Walmart's online sales and grocery pickup, changing customer habits. And from 2021 to today, Walmart focuses on upgrading stores and using technology to improve the shopping experience. Okay. If you look at how much customers typically spend per transaction at Walmart, globally the average ticket is usually around $60 to $70. The fee changes a lot depending on the region. In the US, their spending is a little higher. For example, average store trip is around $54. And online ordering used to be bigger, around $100 and $125. And when it comes to grocery pickup or delivery, the average order value goes around $120. So overall, what we can see is that the US customers spend more per visit compared to the global average when they shop online.
Okay, going to the global revenue breakdown. Here we can clearly see that Walmart, the US, is a powerhouse, accounting for nearly 70% of our local revenue. The remaining revenue is split between our international operations and Sam's Club, our member base warehouse division. Okay, let's examine the US sales mix by department. The main takeaway here is that the grocery is the dominant category, making up over 40% of our sales. Grocery is critical because it drives a single frequent traffic. It also is important to note that e-commerce is a significant and growing part of our business, contributing nearly 30% of the US sales.
Sales forecast. This chart shows our sales growth from 2019 to 2026. At the beginning, sales were around 519 million, with a little dip to 2020. From 2020 onward, we see a steady growth each year. Sales increased to 555 million in 2021 to almost 701 million in 2026. This upward trend shows strong performance, successful strategies, and consistent improvement over time.
Here we have our balance sheet overview. So as you can see here, the balance sheet shows that Walmart is a strong and stable company. It has plenty of resources to operate smoothly day to day, but also investing heavily in stores, technology, and distribution network. Its liabilities are normal for a company of its size and reflects its large-scale operations. And the strong equity position shows that Walmart continues to create long-term value and maintain a solid financial foundation. Then our WACC calculation, that is 7.8%, shows that company can access capital at very low cost, meaning that it's cheap for Walmart to finance new projects, expand operations, and invest in innovation. The low cost of debt reflects that Walmart's strong credit worthiness, while the moderate cost of equity shows that investors view Walmart as stable and low risk. The healthy balance between debt and equity financing supports sustained growth without exposing the company to unnecessary financial risk. Overall, a low WACC, this one, means Walmart can continue expanding efficiently and maintain its competitive edge. Then we have our CapEx. So our 2026 CapEx plan shows how Walmart is investing strategically to strengthen both our physical and digital infrastructure. We're putting money into new land for fulfillment centers, expanding high-demand distribution regions, and upgrading existing sites with energy-efficient improvements. A major portion goes toward remodeling stores, adding sustainability features, and expanding retail fulfillment capabilities. We're also modernizing warehouse machinery, enhancing in-store technologies like self-checkout and smart inventory devices, and building our EV delivery fleets. Beyond physical assets, we're expanding leased properties, construction new tech-enabled fulfillment centers, and upgrading regional warehouses to support faster e-commerce shipping. And finally, we're investing heavily in digital platforms, AI forecasting, cybersecurity, cloud services, and e-commerce technology that keep Walmart competitive and future ready.
Next, for our expense assumptions, we have Walmart's expenses are mainly driven by SG&A, which makes up about 42 to 43%. Second, digital investments may come next around 17 to 18%, followed by depreciation at about 7%. Other costs like sustainability and insurance represent 6 to 7%, while membership and corporate functions add between 7 and 50%. Overall, total expenses slightly increased from 139 million in 2025 to 144.6 million in 2026. Next, for our cost assumptions, we have that Walmart costs are mostly driven by product procurement, which accounts for 57 to 59% of total expenses. Labor for store, purchases, and distribution adds around 16 to 18%, and logistics and transportation contribute to another 10 to 12%. Technology and e-commerce stays below 5% combined, and administrative overhead remains under 2%. Overall, total cost rises from 511 million in 2025 to 528 million in 2026. Now for sales assumptions, we have that for 2026, we're expecting an overall sales growth of about 2.9%. The strongest increase comes from our dry grocery around 16%, snacks at 8%, and electronics and health and beauty around 4%. Everyday items such as frozen foods, dairy, and household cleaning also show steady growth of about 3 to 4%. Meanwhile, accessories like books and medical services remain stable with less than 1% growth. Our sales are expected to grow from about 681 million in 2024 to 701 million in 2026. The US remains our main market with around 82% of total revenue, while other regions stay steady. Physical stores continue to be slightly decline from 82 to 8%, while e-commerce grows from 18% to 12%. This shows our steady store base expansion.
So in conclusion, Walmart does not need external funding for its strategic projects, as the company has sufficient cash and short-term assets to cover its planned investments. However, if additional financing were ever required, Walmart would prioritize debt financing because the cost of debt, that is approximately 5.35%, that one is significantly lower than the cost of equity at 9.09%. So choosing debt over equity will minimize financing costs and preserve shareholder value. Overall, Walmart's strong liquidity, balanced capital structure, and low WACC demonstrate that the company is financially stable and well positioned to support its long-term growth strategy. Thank you.
Can you show me the income statement?
I only have the sales forecast.
Okay, that's an observation, please, because at the end you included everything we needed in the presentation, but try to start with the full picture. Income statement, that's the full picture, then go to the assumptions. Now, you started with the end and then move on to the beginning. The way to present it is preferably because all the companies want to see the results of the operations, first of all, which is the income statement. Start with the income statement. What's the first part of the income statement? Sales. Start with the sales assumptions, cost assumptions, expenses, and then move on to, okay, after that, after the operations, the final balance is the balance sheet. Balance sheet, capital expenditure, the cost of financing, conclusion. It's just a matter of arranging properly your sheets because at the end it has all the elements.
It's very clear.
For me, it was clear also. Thank you. Very much.
The last one. Okay, afternoon. We're gonna present, we already presented the accounting for the rapport. Now we're gonna present financial analysis, which is an overview of the year's analysis of the company. So the team is made up by Diego Gutierrez, by Odette Samson, by Mila Vincent, and by Miguel Garcia. So, we already talked about that.
Well, we got the competitors. We got Google, that is competes for the Android phones and cloud services. Then we got Dell, competes with computers, and and Microsoft that competes with PCs, operating systems, cloud services, software, and web solutions.
Okay, we analyze the gross margin for Apple 25, that's equal to 7%, Microsoft has 9, 22%, and Google at 8%. Based on the analysis, Microsoft leads with gross margin of 69% for outpaces Apple, this stands for 7%. So Google's performance well at 58%. Microsoft is the highest in money, reflecting its superiority, pricing strategy, and cost control. Dell, with a much lower margin of 10%, is significantly behind in the areas you get higher cost or lower efficiency managing performance services. And also, the profitability ratios I like here based on operating value. Apple also 32%, Microsoft 46%, and Dell 7%, Google 8%. Microsoft leads with an operating margin of 6%, reflecting more efficient management of operational expenses related to revenues. But Apple's and Google are tied at 2%, showing that they have similar operational efficiencies. There is a significant low operation margin of 7%, which indicate a poor operational efficiency and high expenses related to not available to invest. And in the profitability ratio again, we also have Apple at 8%, and Microsoft at 10%, they have 2%, Google at 61%. Google stands out, as I said, the margin of 61%, meaning it keeps a much lower portion of its revenue as profits after our expenses. Microsoft follows with 10% slightly higher, Apple at 8%. Dell has a net margin, indicating that it's not as effective in converting revenue to profits, and that's not for all expenses. Here we have the highlight of the ROE, which return on equity as Apple, which is 44% at 2025, and Microsoft at 8% or so. Okay. Let's go down to return on asset on Apple A, and Apple at 9%. Microsoft 5%, 3% lower. So based on the return on equity, double leads on a bit of 65%. Meaning it provides a significant return on its shareholders compared to ETP. Apple follows with a solid 44%. It also provides a good return for its shareholders. Microsoft has much more lower ROE, return on equity of 8%, showing that it is a share and user shareholders agree to benefit from. Dell has a negative ROE of 120%, suggesting it's not value shareholders.
Then we have the revenue rates analysis, working capital. When we examine working capital for these companies in 2025, Apple and Dell both showed negative working capital, with Apple at -$30,674,000 and Dell at -$10,298,000. This indicates that the current liability exceeds the current assets, which may possess pose a risk to their ability to cover short-term obligations without seeking additional funding. In contrast, Microsoft and Google both report positive working capital, accumulated at $70,589,000 in 2025. Positive working capital means these companies are in a stronger liquidity position, able able to meet their short-term liabilities and invest in future growth. Given these insights, Microsoft and Google are better positioned in terms of liquidity, with Google standing out with its strongest working capital. Apple and Dell, with their negative working capital, face liquidity challenges, which may affect their financial flexibility in the short term. Then we have current radio. When we analyze the current radio for these companies in 2025, Apple, Microsoft, and Dell all have a radio of 1, which means their current assets are equal to current liabilities. While this suggests they can meet their short-term obligations, there's a little room for unforeseen expenses or sudden financial challenges. Microsoft 2024 has a slightly higher rating of 1.27, indicating it has a comfortable margin to cover its short-term liabilities. On the other hand, Google stands out with a current rating of 2, meaning it has twice as many current assets as current liabilities, providing a significant cushion to absorb unexpected costs and for liabilities. Given these findings, Google leads with the strongest liquidity position, followed by Microsoft 2024, which also has a solid current ratio. Apple and Dell, with their neutral ratio of 1, are in more vulnerable position and could face challenges with their liabilities increase unexpectedly. Then we have a quick radio. The quick radio measures a company's ability to meet its short-term obligations using its most liquid assets, excluding inventory. A ratio of 1 means the company has just enough liquid assets to cover its current liabilities, but just enough, but offers no extra flexibility in this analysis. Google leads with a strong quick ratio of 2, demonstrating it has a robust cushion of liquid assets to easily meet its obligation with relying on inventory. Meanwhile, Apple, Microsoft, and Dell all have a ratio of 1, meaning they can meet their short-term liabilities, but have limited room for flexibility if unexpected cash needs arise. Based on this, Google is a clear leader in terms of liquidity, proving a solid buffer of liquid assets. Apple, Microsoft, and Dell are all in neutral positions with no extra cushion to absorb sudden financial stress, putting them at risk with additional cash required. Then we have IC ratio. The asset test ratio or cash ratio measures the company's liabilities using cash alone. In this case, all companies, Apple, Microsoft, Dell, and Google, have a ratio of 0, meaning they don't have enough cash on hand to cover their short-term liabilities without relying on other assets, such as receivables or inventory. While this might seem concerning, it is typical for large companies to operate this way, as they often rely on more liquid assets and have a strong access to credit. Therefore, while the 0 ratio indicates that these companies don't have sufficient cash alone to meet their liabilities, it's not an immediate red flag, especially considering the other liquidity sources that overall financial strength. This ratio alone shouldn't cause concern when we start to establish companies.
Well, we have the total debt to total shareholders. The total debt to total shareholders equity ratio measures the company financial leverage with a higher ratio, indicating more reliance on debt. In 2025, Apple has a relatively high ratio of 1.34%, an improvement for 1.87% in 2024, showing that while it still carries significant debt, its leverage is decreasing. Microsoft and Google have very low ratios of 0.18 and 0.08. Respectively indicating low reliance on debt and strong financial stability. Well, the total debt assets already reduced the proportion of the company assets financed by debt. In 2025, Apple has a ratio of 0.27, meaning that the 27% of the assets are funded by debt. the total shell progress equity to total assets. The total shell progress equity to total assets ratio measures how much of a company assets are financed by equity rather than the debt. A higher ratio signifies the less reliance on debt and greater financial stability. Google leads with a strong ratio of 0.72 in 2025. Meaning that most of these assets are funded by equity, indicating strong solvency and low financial risk. Microsoft also performs well with a ratio of 0.55, demonstrating a solid equity base and good financial stability. Okay, so now we have the financial cycle analysis. So we have account receivable rotation and inventory rotation. So you can see Apple has relatively stable accounts with a rotation of 5.6 in 2025, slightly lower than in 2024. So this is a slowed up and ability to bring receivables to cash. Microsoft shows an increase in receivable rotation to 4.95 from 4.31 in 2024. So they have there's an improvement in collection efficiency. And then Google have strong accounts receivable rotations with 6.69 and 6.13. Okay, and then we have the inventory rotation. Apple sees the increase in inventory rotation from 53.67 to 38.11. So Microsoft shows an inventory rotation of 26.10 from 196.73 in 2024. Dell has a rotation of 14.23, and Google has a rotation at 0 because the business model does not rely on physical goods. Then we have the accounts payable rotation. So Apple has the decrease in the accounts payable rotation from.
You need to move on and let's move on to the conclusion.
Okay, so we have the value of the stock of Apple. Well, there is many good things. I'm not gonna go in depth because we don't have many much time. There's also the cost of debt and their return on equity and investments, which is something that you have to have in mind in order to be able to invest in Apple. And
after analyzing the financials of all the companies, it's clear that Microsoft and Google are the best options for investment. Microsoft stands out with strong profitability, excellent interest coverage, and low debt, making it a reliable choice for investors seeking stability and growth. Google, with its low debt reliance, strong ROE, and ROAS, it's also solid investment, particularly for those seeking long-term financial stability. Apple, while profitable, face risk in its interest coverage ratio of 0.00, indicating potential struggles in meeting interest obligations. Its high reliance on debt and slower working capital cycle also raise concerns. Dell is the least attractive investment with negative liquidity and significant financial concerns. Our recommendation is Microsoft is the best choice due to its efficient operations, low debt, and strong financial position, followed by Google, its solid solvency and liquidity. Apple is a solid option but carries more risk, while Dell should be avoided.
Questions?
Here.
Guys, if Microsoft is better than Apple, which your conclusion must be aligned to your thesis, to your hypothesis, you need to conclude from Apple. Okay, well, if you, with your fundamental analysis, say that it's better to invest in Microsoft, why is people investing in Apple? Why do you think they are investing in Apple?
well, first, I'm not saying something that's not maybe like related to like finance, but I believe people are more attracted, like the population, the young population, and people are more attracted to what Apple offers because of what they represent, that what Microsoft does. So that's probably something that that's like the first thing that can come into mind. It's not talking about any numbers or any analysis.
Okay. Do you want to complement?
I feel like, just like the recommendation, I feel like Microsoft and Google have this operational efficiency. So that's just what I feel like there's one.
What would it need to change in Apple in order to be your recommendation?
What they need to change now?
Yeah. In the financial stuff.
Was, as we mentioned over here, since they're very dependent on financing with debt or capital, that gives them like a lot of risk for like the future. So I believe if they found a way to attack more of these like account receivables or how they manage how they their payments and everything, maybe that would be a way to reduce the risk of investment on Apple.
Also, Apple is a company of all four that invest more and receive less. And Microsoft is the one that invests less and receive more earnings. So I think Apple should use search how to lower cost machinery or their factories like that to invest less and have more earnings and those
Guys, I know that you may all heard that when you're presenting, just put three words, bullet points. Okay, I don't care if it's too much text sometimes, but that's way too much text. Go back to go to your profitability ratios, please. Look, the thing is that if you put that much text, I will keep reading it rather than putting attention to you. And, or in the numbers, like for instance, there are a lot of mistakes in your peers analysis. In all the charts, like net margin 0 from 2024, but you have net margin in numbers. Go to the net margin percentage on 2024 for Apple, it says 0. How is that it has 0 if you have 24 million of net profit? That's a mistake.
So I remember asking students.
No.
So the formula of net margin is
Net margin divided by sales. You should know that. So, well, go to the liquidity. All the conclusions from the liquidity are wrong. All of them. Why they are wrong? Because the liquidity analysis, it's not 1 or 2. It has decimals. You took out the decimals. You left 1 decimal for, I don't know which company means that. I don't know. I don't know because you didn't leave the headers. I don't know what I'm reading in the table. Which by that means also the table is awful because you just copy and paste from the Excel. You didn't give not even a little bit of format. But the conclusions are based on that the liquidity of all of them, it's 1, and that's not correct. It is 1.3 like the number that you have in there, 1.27. And it's the only conclusion that you have. Go to the solvency. It's the same in here, like in here. You have decimals in here. But you didn't put the headers. I don't know what I'm reading, okay? and it's too much text, That's why it took you a lot of time to do your presentation.
Yes.
And we didn't even saw like the WAC or other things. Take that into consideration because you did pretty well on managerial accounting, but in this, I was a little bit disappointed. Okay?
Thank you.
Thank you, guys.